Welcome to the Deep Dive. Today, we are plunging headfirst into a company sitting squarely at the very epicenter of the artificial intelligence explosion, CoreWeave.
Yeah, they're definitely right in the thick of it.
The AI boom is creating this absolutely massive new gold rush,
Yeah.
right? And just like any gold rush, this one needs serious infrastructure. We're talking about the modern-day equivalent of needing sturdy pickaxes and efficient shovels.
Absolutely. The picks and shovels of the 21st century.
Our insights for this deep dive are pulled directly from some really fascinating material you shared with us, specifically an analysis from the One More Money blog.
That's right. And our mission here is basically to unpack their critical bull versus bear case analysis for 2025.
Okay.
We want to help you think through that key question. Is CoreWeave Stock, ticker CRWV, is it a buy? This is your custom deep dive into this material from the One More Money blog.
Got it.
And the One More Money blog, they zero in on CoreWeave and describing it as a specialized cloud provider.
Specialized. Okay.
And critically, the critical purveyor of high-performance GPUs, basically, the engine needed for this AI boom we're all seeing.
Let's really lean into that AI gold rush metaphor the One More Money blog uses. I think it's such a vivid way to understand what's happening.
It really is, captures the frenzy.
And the blog shares this truly striking detail that just underscores the sheer scale of demand, ChatGPT's user growth.
Oh, yeah. That was wild.
It famously took them 5 days to hit 1 million users initially, right?
Seems like ages ago now.
But the One More Money blog notes that recently, they onboarded 1 million users in a single hour.
1 hour.
Think about that jump. That just highlights the mind-boggling demand for computational muscle.
It's incredible. And what's fascinating, as the One More Money blog points out, is that in this AI gold rush, the actual pickaxes, well, they aren't steel.
Right.
They're graphics processing units, GPUs. These specialized chips, mostly from Nvidia, are absolutely essential for training and running these complex AI models at scale.
So CoreWeave saw this coming.
Well, their core business model, as described in the One More Money blog, is elegantly simple in concept.
Okay.
Acquire massive quantities of these powerful GPUs, mainly Nvidia's best, and then rent that computing power out to the companies building AI.
So they're supplying the miners, basically.
Exactly, the indispensable suppliers in this modern rush.
And here's where their story gets really interesting, according to the One More Money blog. CoreWeave didn't start here.
Right, they had a previous life.
They actually got their start in the original digital gold rush mining Ethereum back in, 2017?
That's right.
But in 2018, they made this pivotal strategic shift. The One More Money blog calls it visionary.
And probably rightly so.
Because they pivoted entirely to focus on AI compute long before the current AI explosion really hit its peak.
And that early experience wasn't just, a random detour.
Right.
That time spent building and managing these large-scale, high-density Ethereum mining operations taught them invaluable lessons.
Like what specifically?
About handling complex computing hardware at scale, everything from power, cooling, deployment logistics, things that are absolutely critical now for running these massive GPU clusters for AI, they learned the hard way.
Okay, so that experience gave them an edge. Now, moving on to what sets CoreWeave apart today. The One More Money blog makes a strong case that it's their infrastructure, right? They call it purpose-built for AI.
Exactly. And that's not just marketing fluff, according to the blog. It means their entire technology stack, how they design data centers, their networking, the software layers, it's all engineered specifically to optimize these huge AI workloads.
So totally different from the big cloud providers like AWS or Azure.
Well, different focus. For the generalist providers, AI compute might just be one offering among many, databases, web hosting, storage.
Gotcha.
CoreWeave is all in on AI compute. And this deep specialization, the One More Money blog argues, creates a kind of flywheel effect.
A flywheel? How does that work?
Superior performance in AI workloads attracts the leading AI companies, the ones who really need that speed and efficiency.
Makes sense.
Then, their demanding applications generate insights, data, that CoreWeave uses to continuously improve their platform.
So they learn from their top customers.
Exactly. Which in turn attracts more customers looking for that specialized edge. Performance drives customers, customers drive improvement, improvement drives more customers.
And the One More Money blog mentions tangible benefits for the clients because of this.
Oh yeah, we're talking faster training times for models, smoother inference. That's when the AI actually generates results.
Crucial stuff.
And critically, during demand surges, the blog says their job queuing is multiples faster than the generalized solutions.
Wow. Okay. For companies racing to deploy AI, that speed advantage must be huge.
Absolutely critical. Time is money, especially in AI development. And the One More Money blog also points out CoreWeave's focus on staying cutting edge, noting they were the first cloud provider out there, offering instances of Nvidia's absolute latest, most powerful Blackwell GB200 systems.
Blackwell, okay. Being first with the best hardware is a big deal.
A very good deal when everyone wants the latest and greatest.
Now, speaking of Nvidia, the One More Money blog really emphasizes the relationship CoreWeave has with them, calls it deeply intertwined and strategic. This sounds like more than just CoreWeave buying chips from Nvidia.
It definitely is. Much more. The One More Money blog describes CoreWeave as one of Nvidia's absolute largest customers. They spend billions on GPUs.
Billions. Okay, so they're a vital sales channel for Nvidia's data center business.
For sure. But, as the blog notes, the relationship goes much, much deeper. Nvidia is also a key investor in CoreWeave.
Ah, okay. Nvidia put money in.
And Nvidia is also a major customer for CoreWeave themselves. It goes both ways.
Wait, a customer? How does that work?
This is the fascinating twist the One More Money blog details. Nvidia's early investment wasn't just cash. It gave CoreWeave priority access to hundreds of thousands of high-end GPUs.
Whoa. In a market where those chips are like gold dust.
Exactly. The One More Money blog rightly calls this a priceless advantage. Without that priority access, they wouldn't have the capacity to sell.
Okay, that's huge. But Nvidia being a customer.
Yeah, get this. The blog highlights a deal from the start of 2024 where Nvidia was actually CoreWeave's second largest customer at that point.
No way. What were they doing?
Essentially, Nvidia was renting back its own cutting-edge hardware from CoreWeave for its own internal R&D.
Renting its own chips back.
Yep. The One More Money blog describes this kind of reciprocal deal as strategic bonding. It really ties the two companies together.
Wow. Okay, that is deeply intertwined. So with that purpose-built infrastructure and this critical Nvidia connection, it maybe makes sense that the One More Money blog details some massive contracts CoreWeave has landed.
Yeah, some really big names are relying on them.
The most eye-catching one mentioned is with OpenAI.
The ChatGPT folks.
An initial deal valued up to $11.9 billion.
$billion with a B.
Huge number. Followed by an additional commitment, the blog says, of up to $4 billion in May 2025.
Just staggering amounts of compute power needed there. And the One More Money blog also details that Microsoft is a cornerstone client.
Cornerstone, okay. How big?
Accounting for, get this, an astonishing 72% of CoreWeave's revenue in the first quarter of 2025 alone.
72% from Microsoft.
Yep. The blog explains CoreWeave's role here, acting partly as an overflow provider for Microsoft Azure.
Overflow, meaning Microsoft can't build fast enough themselves.
Pretty much. Even a tech giant like Microsoft, with all its resources, is struggling to build AI infrastructure fast enough on its own. They need to turn to specialized providers like CoreWeave for extra capacity.
That really speaks volumes about the demand. The One More Money blog also notes they've landed another major hyperscaler customer, widely reported to be Google.
Right. Another huge player needing massive GPU power. And these aren't just like pay-as-you-go deals. The One More Money blog points out that many of these are long-term take-or-pay contracts.
Take-or-pay, what's that mean?
It means the customer commits to pay for the agreed-upon capacity, whether they fully use it or not.
Ah, okay. So CoreWeave gets paid regardless.
It provides a significant level of revenue visibility, which is pretty rare in this fast-moving space. The One More Money blog says this contributes to a massive revenue backlog of over $25 billion.
$25 billion in backlog. Wow. That's a lot of future revenue locked in potentially.
Huge number offers a real glimpse into their potential future revenue streams.
All right, let's get into the CoreWeave financials then. The One More Money blog frames this part as a high-stakes game of hypergrowth. Sounds about right.
The revenue numbers are indeed explosive, according to the blog. CoreWeave reported Q1 2025 revenue of $981.6 million.
Almost $1 billion in one quarter.
And the One More Money blog notes this was a jaw-dropping 420% increase year over year.
420%, just wow.
And looking ahead, the blog points to management's full year 2025 revenue projection, somewhere between $4.9 and $5.1 billion.
So roughly $5 billion for the year. Serious growth by any standard.
Absolutely.
But this kind of hypergrowth, it must require immense capital investment up front, right?
Yeah.
Mostly buying all those incredibly expensive GPUs.
Exactly. That's the catch.
So the core of the bull thesis, as the One Money blog presents it, is management's argument about the cash payback period.
Right, how quickly they recoup that huge investment.
They claim the investment in new hardware pays for itself in, what, roughly 2.5 years?
That's the number they put out there.
And the implication, as the blog outlines, is that after that initial period, those assets, those GPUs, essentially generate pure profit for the rest of their useful life.
Assuming they still have useful life.
Right, but that's the argument justifying the heavy spending if demand stays sky high.
Precisely. That's the bull case in a nutshell. However,
Yeah.
the One More Money blog is very, very clear that investing in CoreWeave is not for the faint of heart.
Okay, so here come the clouds.
Alongside that compelling growth story are some pretty formidable risks that need careful consideration.
What's risk number one?
The first major one highlighted is technological risk. GPUs are evolving incredibly fast, like lightning fast.
Faster and faster every year, it seems.
The blog points out that new, more powerful hardware from Nvidia, or maybe even competitors, could potentially make CoreWeave's current multi-billion-dollar asset base significantly less competitive, or maybe even functionally obsolete in just 1 or 2 years.
1 or 2 years. That's way faster than typical data center gear.
Much faster. And it poses a real challenge. Billions sunk into assets that might underperform very quickly.
That pace of obsolescence is a huge factor. And the second risk the One More Money blog dives into.
It's about financial quality and sustainability. Because for all that amazing revenue growth, the company is not yet profitable.
Still losing money.
They reported a net loss of $314.6 million in Q1 2025. And maybe even more concerning, the blog notes their operating expenses actually grew faster than revenue in that quarter.
Ouch. That suggests potential margin pressure, right? Costs rising faster than sales.
Exactly. And the financial structure itself adds risk. The One More Money blog flags a heavy debt load.
How heavy?
$8.7 billion as of Q1 2025. Billion.
Wow. Okay.
This results in rising interest expenses, naturally, and the blog warns this could create a dangerous cycle if they need to keep borrowing more just to service the existing debt.
A debt spiral. Not good.
And there's another nuance the blog highlights. A difference between reported earnings, like adjusted EBITDA, which was $606 million in Q1.
Okay. Sounds good.
And actual cash generated from operations, which was only $61 million in the same quarter.
Whoa. Big difference. Why?
Partly due to accounts receivable, basically. Customers haven't paid their bills yet, so the cash isn't actually flowing in as quickly as the earnings are being booked on paper. And cash is king, especially when you have massive debt payments.
Right. You need actual cash to pay the bills and reinvest.
Yeah.
Okay. What's the third risk from the blog?
Customer concentration. We talked about Microsoft.
Yeah, 72% of revenue in Q1.
Exactly. The blog points out that's an extreme reliance on just one single customer.
So if Microsoft changes strategy or builds its own stuff faster,
it could have a really significant, maybe devastating impact on CoreWeave's top line. That's a lot of eggs in one basket.
definitely a risk. What else?
The One More Money blog also mentions a fourth potential risk: slowing growth momentum.
Slowing. But the numbers look huge.
Well, while the year-over-year revenue growth is massive, yes, the blog notes that some analysts see signs of slowing growth in something called remaining performance obligations, or RPO.
RPO, that's the backlog, right? The $25 billion.
Sort of. It's basically the revenue they expect from contracts already signed. A slowdown in the growth rate of that RPO could suggest that new contracts aren't coming in quite as fast as they're burning through the existing backlog.
Ah, okay. So the rate of new business might be easing off a bit. That's subtle but important.
Could be an early indicator.
And finally, what's the last major risk?
Finally, the One More Money blog discusses market and valuation risk. The stock's been volatile since its IPO back in March 2025, and the blog describes the valuation as stratospheric, meaning it's priced incredibly high relative to traditional metrics like earnings or sales. It basically prices in flawless execution and assumes this hypergrowth continues perfectly.
No room for error, basically.
Pretty much. The blog also points out the potential risk from insider lockup expiry periods.
When early investors or employees can finally sell their shares?
Exactly. That could create significant selling pressure on the stock price when those lockups expire.
Okay, so a lot to weigh on the risk side.
Definitely. So pulling together the whole analysis from the One More Money blog, the overall assessment is really this delicate balancing act. You've got a very compelling, undeniable hypergrowth story.
Right.
Up against a very, very high-risk profile.
So let's summarize the bull case points from the blog again.
Okay.
You've got a pure play investment in core AI infrastructure, a unique, purpose-built platform. that super strong strategic partnership with Nvidia.
Good.
Blue chip customers like OpenAI and Microsoft signing massive deals, and significant revenue visibility from those long-term take-or-pay contracts.
Right. And if that demand for GPUs keeps outstripping supply like it has been,
Yeah.
their revenues and eventually potential profits could just multiply rapidly from here.
That's the dream scenario for bulls. Now, bear case points from the blog.
Equally potent.
Yeah.
They are burning cash, not profitable yet. They're heavily leveraged with billions in debt.
Right.
Highly dependent on a few key customers, especially Microsoft, and one absolutely critical supplier, Nvidia. Their core assets, the GPUs, are subject to that rapid technological obsolescence risk we talked about.
Yeah, the 1 to 2 year threat.
And the current valuation is seen as extremely expensive by almost any traditional measure.
A lot of hurdles there.
Big ones. And the One More Money blog mentions that the Wall Street consensus rating is currently around a hold.
Now to buy.
Generally a hold, with average price targets actually suggesting significant downside from where the stock has been trading recently.
Wow. Okay, so analysts are cautious.
It really reflects this deep uncertainty about how these competing bull and bear forces are actually going to play out. It's not clear-cut at all.
So the way the One More Money blog frames the actual investment decision, buying CoreWeave stock is really a high conviction bet. Is that?
I think that captures it well. It's a bet on the AI boom continuing full steam ahead, right? A bet on CoreWeave successfully keeping its technical edge, maybe through that Nvidia relationship, and a bet on them managing their really complex financial structure, the debt, the cash burn.
It's a bet that GPU shortages continue.
Right.
And that CoreWeave's specialized performance advantages remain valuable enough for customers to keep signing those huge long-term contracts.
Yeah.
A lot has to go right.
A whole lot. The One More Money blog concludes this section by suggesting, look, for risk-averse investors, the current valuation and those financial risks are probably prohibitive. Just too much uncertainty, too much debt.
Makes sense.
But for aggressive growth investors, the ones really looking for a direct play on AI infrastructure itself, it represents one of the most direct ways to get that exposure, albeit, as the One More Money blog notes, probably the riskiest way too.
Direct but risky. Okay. So you've heard the powerful bull case presented in the One More Money blog, that explosive growth, key partnerships, massive contracts, unique position. And you've heard the equally significant bear case, that massive debt load, the risk of rapid tech obsolescence, serious customer concentration, cash burn, and that sky-high valuation.
It's a lot to digest.
Definitely.
So based on this deep dive into the One More Money blog's analysis, here's something to really chew on for yourself. Given the rapid, almost dizzying pace of hardware innovation and CoreWeave's significant financial commitments, particularly that huge debt pile, can the company truly continue to outrun these massive risks indefinitely? Or is the current hypergrowth trajectory actually just a race against time? Before one of those formidable challenges, the tech changing, the debt catching up, a key customer leaving finally catches up with them?
That's a really sharp question. A race against time. Okay, that was a truly fascinating deep dive into the CoreWeave bull versus bear case, all thanks to the insights and analysis provided by the One More Money blog.
It's a complex picture for sure. Really highlights both the, immense opportunity available in the AI infrastructure space right now,
Right.
and the significant, maybe unprecedented challenges faced by companies trying to capitalize on it at this scale and speed. It's not easy.
Not at all. And as always, the One More Money blog included a disclaimer with their analysis, and it's important for us to share it with you.
Okay, I'll read that out. Disclaimer. This article is for educational purposes only and does not constitute investment advice. Investors should conduct their own due diligence before making any financial decisions. We are not responsible for any investment losses incurred based on the information provided in this article.
Thank you for watching this deep dive.
Yeah, thanks for tuning in.
If you're interested in U.S. stock investment, please make sure you subscribe to the One More Stock channel so you don't miss out on the latest videos in the future.
Good idea.
And please, give us a like and leave a comment below. We would absolutely love to know what you think about this topic.
Yeah, definitely.
Specifically, based on everything we discussed from the One More Money blog today, do you think CoreWeave is a buy or not? Let us know your thoughts.